Buying the Bitcoin bottom. This video is for educational and informational purposes only. So where is the bottom? It seems that crypto has been in a bear market for some months now. Question now is how long will it last, and did we hit the bottom yet? It's almost impossible to try to predict the bottom, but in this series I'll provide you with unique insights to help you decide. Remember, Bitcoin and crypto are highly volatile assets, and you can lose 80 to 90% at times. So invest only as much as you're comfortable with so you can hold through the downturns. The Bitcoin bull market that many expected in 2021 did not have a parabolic top, as it has almost every 4 years in the past. However, a more rounded top did occur around November 2021, precisely when people expected a top based on previous 4-year cycles. First, we need to evaluate Bitcoin based on its internal fundamental and technical factors. I call this the microeconomics of Bitcoin. You want to look at historical price movements, cycles, and adoption. Bitcoin is actually easier to evaluate because there are very few factors that influence Bitcoin prices that are internal. Unlike a business that can be affected by bad management, the success or failure of new products, or earnings releases, Bitcoin is very simple. There are extreme price swings based on the general opinion about if Bitcoin will be the new money of the world or perhaps irrelevant. Hence, the Bitcoin price has had many cycles and has gone up over 100 to 400 times in price early on, but also lost over 80% at times. From 2011 to 2013, prices went from $2.40 to $1,160 for a 409x gain. It later went down to $150 from 2013 to 2015, down 87%. It rose back up to 19,800 from 2015 to 2017 for a 130x gain, then went back down to $3,100 from 2017 to the end of 2018, down 83%. Then it rose again 22 times to its all-time high around 69,000 from 2018 to 2021. It's currently down over 70% to around 19,500. Adoption has been steady and increasing significantly over the past decade, and the new supply of Bitcoin decreases every 4 years. So there's an upward price pressure purely on supply, demand, and new interest. We can see a steady increase in those who own at least one Bitcoin since the beginning. Those who have a sizable amount of 10 Bitcoin or more have generally increased despite a slight dip the last couple years. The strongest believers who hold large amounts of Bitcoin and rarely sell also limit supply that allows prices to move up. The big whales who own large amounts of Bitcoin have been increasing their holdings, and the institutions are becoming more comfortable owning Bitcoin. But after recent spikes, the trend has flattened out. Next, we compare Bitcoin to gold. They have similar characteristics as a store of value. Gold has hundreds of years of history, but Bitcoin is more portable and easily verifiable than gold. So Bitcoin is often considered digital gold. We can compare the total value of the entire Bitcoin supply to the entire supply of above ground gold inventories. Currently, total Bitcoin value is only about 4% of total gold value. Bitcoin may eventually catch up to gold, or at least get up to 10 to 50% of the total value of gold in the next decade or two. So Bitcoin has potential to go up 3 times to 15 times relative to gold. One of the best tools that capture much of the internal factors and microeconomics of Bitcoin is the CBBI index from Call and Talks Crypto. Although this index was not very useful for calling the top in the past cycle, I'd consider it a very powerful tool in general and can give you good guidance when Bitcoin is undervalued. The easiest way is just to start accumulating when the index falls below 10 and selling when it rises above 90. It's currently at 8, so this indicator suggests it's already a very good time to buy. There are 9 different indicators that track such metrics as price cycles, profit-loss indicators of current holders, on-chain Bitcoin movements, Bitcoin miner revenue, and other metrics. I'll get into the details in future videos. However, you can see based on the red circles when the signal is below 10, the prices were near historical bottoms. The next big factor you should consider is the macroeconomy. The biggest wildcard this year compared to previous years is the serious risk we are heading into not only a recession, but a deep recession. Cryptocurrency investors have all benefited from the 13-year stock and asset bull market that have had few major downturns other than one sharp but brief downturn in 2020. Hence, investors have never seen cryptocurrencies go through a deep recessionary environment such as those in 2000 or 2008. So there could be greater downside risk. One can even argue that the Fed stimulus since 2008 has artificially magnified the gains of high-risk assets such as Bitcoin. If we go into a deep recession, the stock market may have another 50% to fall, and Bitcoin may fall even more than that. There are some leading indicators we can follow that may give us some early warning signs of a recession. The first indicator is when we have yield curve inversions, when long-term bond yields are lower than short-term bonds, and there is an expectation of an extended economic slowdown. This chart is the 10-year minus the 2-year chart. We see the red circles where inversions occur before recessions. Stock markets peak on average 10 months after an inversion, but the range is wide. Stock markets can peak much sooner or later after an inversion. We can also compare the 10-year yield to the 3-month Treasury yield. Stock markets peak on average 4 months after these kinds of inversions, but again may happen much sooner or much later. The housing market is an early indicator and is the main driver of the general business cycle. In the Great Financial Crisis, the housing market peaked in 2006, but the recession didn't start until 2 years later in 2008. We may be having a more rapid decline after coming down from the 2020 Fed liquidity injection, but cyclical housing data seems to be trending down, and new housing stats seem to suggest a longer-term downturn. Another early indicator to follow is continuing jobless claims. Deutsche Bank stated that when 4-week average continuing job loss claims move up 11.5% from a significant low point, a recession may begin in roughly about 2 months. The latest number was 1.438 million, and we are getting very close to reaching the 1.456 million threshold. We can monitor trends from the Economic Cycle Research Institute, ECRI, that rely on proprietary research of leading indicators. Their statistics show weakness in the economy and that we are at levels very close to previous recessions. However, recent data shows a small positive trend in the last couple weeks. Interestingly enough, in the last couple recessions, when the Fed actually started cutting interest rates, that was a sign of nearing a peak in the stock market. Hence, a rate cut or a pause might be thought of as bullish, but could be an indicator of a deeper recession. It's also good to monitor coincident indicators such as the ISM PMI Manufacturing Index to compare with past recessions to identify the potential magnitude of a recession. We can also monitor the main factors of the NBER, the organization that declares official recessions. They track non-farm employment, industrial production, real retail sales, real personal income. These currently have been trending positively but are lagging indicators. We should pay close attention to Fed monetary policy. Since the 2020 COVID lockdowns, the Fed injected nearly $4.5 trillion into the US economy by buying treasuries and mortgage-backed securities. Now they are in the process of quantitative tightening and selling treasuries, and there may not be enough buyers, leading to higher interest rates and headwinds in bond markets. Some suggest that QT could be the equivalent of raising interest rates by 1 to 3% or more. We can also monitor liquidity from Fed balance sheets, Treasury general account balances, and the repo market. Stock market earnings and valuations help us determine if stocks are cheap or expensive compared to the past. One simple method is to look at historical moving average trends in the market to see if markets are overvalued. We are 37% above the trend line based on this simple metric. We can also compare price to earnings ratios of companies in the S&P 500. It shows we are about 48% above the historical average. The Buffett indicator compares US stock market value to GDP. That shows we are about 37% above the historical average. We can compare stock market value relative to interest rates, and that indicator shows that stocks may be fairly valued. Interest rates are low historically, so low-yielding bonds don't seem to be that attractive relative to stocks, but rates are increasing. Currently, short-term bond yields after inflation are negative 5.85% according to this chart from Pantera Capital. We compare that to historical average real rates of positive 2.63%. All this goes to show that stocks may be overvalued in general, but bonds that have negative yields are not an attractive alternative. So this year, both stocks and bonds have performed poorly, and bonds have not been able to soften the blow of the stock market downturn. In fact, bonds have had the worst returns in the last 45 years. Therefore, we may be heading for a long-term negative yield environment, or what we call a stagflationary environment, where inflation is higher than yields on bonds and where real earnings of stocks are depressed. That's what happened from the late 60s to the early 80s, where we had high inflation, high unemployment, low growth, and high interest rates. So what was the best asset to own in the stagflationary environment of the 60s and 70s? The star assets were gold and silver. People moved to safe havens to preserve their wealth from inflation, away from typical investments such as stocks, bonds, or real estate. From 1975 to 1980, gold went up 8x and silver went up 33 times. I expect that gold and silver will again be a star asset this time around, as well as Bitcoin. The cycles of real assets aren't just in stagflationary environment, but the last commodities boom was at the end of the dot-com boom in 2000, where gold rose 6 times from 2000 to a peak around the time of the Eurozone debt crisis in 2011. Overall, in stagflationary environments or real asset cycles, we can look at commodities, agriculture, and energy. Real assets and energy will be the focus this decade instead of technology. Lynn Alden, in her August newsletter, shows we may be beginning a cycle where value outperforms growth. This trend may capture the beginning of the real asset cycle. We are in a debt supercycle. In 2008, we had a mortgage debt crisis, and as the Fed propped up mortgages, some of the excesses spilled over to auto loans, student loans, and credit card debt. The auto loan bubble is popping, student loans are being subsidized and is unsustainable, and credit card debt may become a problem in a recession. The biggest debts are sovereign debt. The US federal debt is 133% of its GDP, and anything above 90% usually results in stagnation, likely stagflation, or worse. But the US is not even the worst offender. A lot of easy money flowed into the corporate sector. Companies took advantage of financial strategies based on cheap debt and low interest rates. You can see corporate debt to GDP spiked in 2020 and has been trending up sharply the last decade. The problem? We now have more zombie companies whose interest coverage ratios are below 1, meaning companies may not have enough earnings to pay the interest on their debt. According to Credit Risk Monitor, 40% of public US companies fall into that category, and 31% of companies around the world. So we can see the negative impact of higher interest rates on companies, and credit contagion is a serious risk. We'll have to monitor CPI and inflation to see if the Fed can manage to minimize long-term inflation expectations. It seems CPI moves in cycles, and we should see a downturn, especially in the year-over-year stats, but the Fed typically will not stop until the Fed funds rate is above CPI, so that may not happen until the end of the first quarter next year. There is some risk of more supply side and energy inflation. There also might be a reevaluation of real assets based on the debasement of currencies via quantitative easing, so higher inflation may persist. We're having a global meltdown outside of the US. Europe has a severe energy and sovereign debt crisis and is heading towards third world nation status. China's real estate downturn is worse than the US crisis in 2008 and may lead to a banking crisis. Again, real estate is the main driver of all economic cycles, and so China is in deep economic trouble. China provided much of the low-cost labor and products to help the world out of recession since 2008. That's likely to slow down. Japan is known for creativity and inventions, but unfortunately that applies to their central bank that has been innovating on money printing and yield curve control. Japan has the worst sovereign debt crisis, with their internal debt at 250% of GDP, and the central bank owns over 50% of Japanese sovereign debt. And if you look at all the major central banks, they've created 22 trillion since 2008. And maybe that's why Bitcoin. Going back to real assets, over a decade ago, people were concerned about peak oil. That conversation might be coming back as people realize the US shale boom may have been artificially supported by cheap debt. So without enough cheap capital, shale oil may be harder to extract. We have to monitor the US dollar. The dollar is a safe haven when the global economy is melting down. When US Treasury yields go up and the Fed tightens, investor flows increase and the US dollar becomes stronger. There's over 13 trillion in dollar loans outside of the US, and with a stronger dollar, those loans become much more difficult to repay and creates demand for dollars compared to local currencies. This may lead to an emerging market crisis similar to the Asian crisis in the late 90s. Furthermore, when the global economy freezes, like in March 2020, there could be a dollar liquidity crisis, and it's another reason for the Fed to print money and buy bonds to stabilize markets as they did back then. The next area to monitor is geopolitics and war. Economics is one of the major reasons for war, but it's infrequently discussed. There are grand chess games being played, yet most people are only able to see the propaganda. We have dollar hegemony and oil priced in dollars. Many people and countries are reevaluating the value of real assets such as oil and natural gas compared to paper assets such as US and other sovereign debt. We have Russian sanctions and bank seizures and proxy wars against Russia. There are now increased collaborations between China, Russia, and India. We have tensions in Taiwan. Economic crisis can lead to both internal and external conflict, and governments would rather foment external conflict to distract from internal problems. There is a risk of World War III as we come to the last stages of the debt supercycle and sovereign debt crisis. Governments have always been the problem, but they'll blame it on a foreign enemy, make their people believe it was the fault of a foreign enemy, and try to reset their economy and maintain power. The ultimate globalist solution is a world government. That's part of an even larger chess game being played out right now. Yes, the world is falling apart, but macroeconomics and fundamentals sometimes take many years to play out. Politicians and central banks usually can kick the can down the road. As the saying goes, don't fight the Fed. The current macroeconomic factors seem to suggest a deep recession may happen within 18 months. There is a decent chance it happens sooner, so it's good to be balanced, flexible, and ready. So let's talk about the bullish factors in our macro cycle and technical section. Fundamentals take time to play out. Technicals often do a better job forecasting market moves. When the stock market recovers 50% from its lows, that's a strong signal that the bottom is in. That's exactly what happened from June to the end of August. Breadth is a measure of how widespread the momentum is across all companies. And breadth thrusts happen when we go from having a low percentage of companies that are above their 50-day moving average to a high percentage of companies above their moving average. Here we have breadth thrust from 10% to 90%, and the recent one was a bullish sign. Technical analyst Larry Williams has an indicator that measures capitulation, and that triggered last June. It seems to be a consistently good indicator. Williams also follows cycle theories, and according to him, October seems like a good time to catch bottoms. Martin Armstrong is an incredibly sharp economist and has developed a long-term indicator called the economic confidence model based on a pi cycle theory. It seems it has pegged early 2024 as a major market peak. Next, we have Fred Foldvari, an Austrian economist, who spoke about the 18-year real estate and general business cycles and predicted the recession in 2008. Although housing seems to be deteriorating right now, the last peak in real estate was 2006, so that suggests 2024 as a more likely peak. The general business cycle typically peaks a year or two after that. Real estate peaks have occurred at 16 or 17 years, so having a peak in 2022 may not be that unusual. However, that means a general cycle peak still might be 1 or 2 years away. Lastly, stock markets and even Bitcoin might be good leading indicators. So if a recession isn't deep, the downturn could already be priced in. For example, according to Lakshman from ECRI, in 1926-27 or 1945, despite recessions, the market continued to go up. So the S&P 500 going down 23% in the first half of the year could have been an indicator of a recession coming and going. Furthermore, one might argue we're just coming down from a COVID stimulus sugar high. It might normalize before the actual recession hits. I do think we begin a deep recession within the next few years if we are not heading there already. But in the meantime, it's better to maintain a balanced and flexible view. So let's get back to Bitcoin. It's important to distinguish Bitcoin from other assets. In a negative real interest rate environment and stagflation, both Bitcoin and gold should perform very well compared to all other assets. Right now, Bitcoin is highly correlated with the economy and is one of the leading indicators of Fed policy. There is a risk with all assets, including Bitcoin, in a deflationary environment or liquidity crisis, and prices could go down significantly. When the Fed eases, Bitcoin is likely to be one of the first assets to lead in the reflation. When money supply increases and the dollar debases, Bitcoin will likely go up while other markets may remain flat, especially in real terms. Bitcoin should eventually decouple as a debasement-proof asset compared to all other fiat currencies, and Bitcoin may very well be the preferred alternative global reserve currency. If we look at the 70s, gold did well during the stagflationary environment and even during recessions, so perhaps this could repeat for both gold and Bitcoin. And to reiterate, the major central banks combined created over $22 trillion in liquidity since 2008. Again, looking at the micro, and if we follow the CBBI index, we should start accumulating right now since Bitcoin seems very undervalued. As far as timing, the macro suggests there could be a deep recession, so we may see some discounts in the next 18 months. Larry Williams suggests early October might be a good time to buy assets. Mr. Blonde has some good stats that suggest lows in the stock market often occur in the last quarter of the year, October, November, December. So those are the months you should pay particular attention to for market lows to go fishing for some discounts. Timing can be fun, but we should always keep the long-term thesis in mind. So if you believe in Bitcoin over the next 5-10 years, it's better not to try to time the market too much. There are two accumulation strategies you can use. The first is called the dollar cost average strategy, where you can buy a fixed amount each week or month, whether the price is high or low. You can smooth the ups and downs of your portfolio as you average in at different prices. For example, if you have $12,000, you could put in $1,000 each month starting today over the next year. The next strategy is called the limit order strategy. You can place many buy limit orders below the current price and see if you could get filled over time. For example, in March 2020, when Bitcoin was around 8,500, you could have placed limit orders at 8,000, 7,000, 6,000, and 5,000. And when the market went down 40% in a day or two during the COVID panic, you would have filled those limit orders at an average price of 6,500. And in just a matter of weeks, your portfolio would have had gains as Bitcoin quickly moved back above 8,000. This time around, Bitcoin prices are around 19,500. Seems like a good deal already. But with downturns in the stock market and a deep recession, we may see $10,000 to $14,000 prices and maybe even lower. But who knows? We may also never get below the June low of 17,600. So we can combine our dollar cost average strategy with our limit order strategy. Let's say we start with 12,000, like in the last example. We can set limit orders of $1,000 each at the following prices: 19,000, 18,000, 17,000, all the way down to 8,000. You need to find a good exchange like Coinbase, Kraken, or Binance where you can place limit orders. So we placed orders at all these different prices, and let's say Bitcoin prices go down to a low of 14,000 in October before moving up. You'll get Bitcoin between 14,000 and 19,000 at an average price of 16,500. You'll still have another 6,000 to invest, and you can use the dollar cost average strategy over the next 6 months as Bitcoin moves up. So dollar cost average and limit order strategies are very easy and effective ways for accumulating Bitcoin. I'll create a portfolio with this exact strategy, and we can monitor the portfolio over time in future videos. I hope you found this video educational. If so, please hit the like and subscribe button for future updates on the micro, the macro, fundamentals, and some technical analysis for Bitcoin and crypto. Thank you, and see you next time.